and the dips caused by the Fed may be worth buying. Joining us now is Andy Kapyrin. He is co-chief investment officer at Regent Atlantic. Andy, good to have you on. An important time as well. What do you mean by this? What history are you looking at that says the Fed shoves us into recession? It's generally a little softer.
Sure. So when you look at the history of what the Fed does to markets when we have an inflationary problem or when we have the risk of an inflationary problem, is they do exactly what they're doing today. This is a textbook response. It's something that we're not used to because we haven't seen it in such a long time, but it happens all the time. If you look at history going back as recently as the 1990s, the Federal Reserve detects an inflationary problem, hikes rates very quickly, sometimes at paces of 75 basis points a meeting, sometimes even higher than that still, and does it basically in a race with the economy. What the Fed is trying to do is raise rates as quickly as they can without causing the market to get too unsettled. We're certainly unsettled today, but we don't want it to get too unsettled and beat the economy into a recession. Because if they raise rates fast enough to contain inflation, then they can drop rates, do a little bit of stimulus, and we come out the other side of it with a healthy economy and a healthier 2% or so rate of inflation. This is what's happening, and every time the Fed's done that, go back to 1990, go back to 1980, what you see is a lot of market tumult, a lot of turbulence, a decline like what we've seen so far, and eventually a buying opportunity as things start to calm down. Now, I'm not going to be one to call a bottom. This is a very turbulent market. It could well overshoot levels. But if I'm looking at corporate America, I see what looks like fortress balance sheets, what looks like a much more attractive entry point relative to what we started at the start of the year.
That's well said. I mean, listen, I think everybody would agree that inflation is probably going to come down in the months and quarters ahead because it's coming down off these insane highs. The economy will slow down. Housing may go up, but energy costs, at least for gas, electricity prices are up. We'll see. All right, so how would that benefit a company like a Pepsi?
Sure. So what benefits a company like Pepsi is just the sheer diversity of what they do. We, of course, know the Pepsi brand as a beverage brand, but it also does snacks. It does Quaker oatmeal. It's globally diverse, and it's been really successful at being able to pass through the increased input costs into higher costs down at the grocery store. So it's maintained its margin. And what you see in Pepsi is a company that, in a very turbulent market, has done a really good job of maintaining its value, continuing to pay its dividend, continuing to hike it.
Yeah, and then you've got, of course, a Home Depot. We just talked about 7% mortgages.
Yep.
I guess the thesis is, okay, we're not moving. Let's just put on a new deck because we can't afford to buy a new home, so maybe we'll just throw on another room. I mean, it's simplistic. You buy into it?
Of course I do. So what I see in Home Depot is one of the best managed big box stores, period. Now, it happens to be a big box store that focuses on home improvement. And in my opinion, that's a really good place to be for the near term. For the next couple of years, we're likely to have mortgage rates that are prohibitive to buying a new home if you already have one. So if you locked in a rate of 2.63% over the course of the past few years, it's going to be really hard for you to upgrade without really upgrading your payment at the same time. That's going to make it more attractive to make the home you're already in nicer. It's going to create a cycle of home improvement, in my opinion, that could really drive sales at a retailer like Home Depot.
Shepard Smith here. Thanks for watching CNBC on YouTube.